You look at the number of short buys hedge funds as tracked by HFR, and it's fallen dramatically from 50-something to 14 now. 50-something in 2008 and 14 in about 2023, 2024. How much does the rate environment overall contribute to the shrinking universe of short-selling funds, do you think?
Well, I think the rate environment is probably the first or second derivative. I mean, it's really the ongoing persistence of the bull market, which has now been 15 years. And we saw something similar, Scarlett, in the late 90s, where the number of short biased funds by 1999 and 2000 really had dwindled to a handful. And people just got exasperated. And that was right before there was really 10 years from 99 to 09 of just fantastic returns on the short side, and two bear markets, of course. But I think that really it's the length of time beyond just Fed policy, although Fed policy certainly had a lot to do with it in the last 10 years.
Now, I introduced Chanos and Company. It's now a family office and advisory instead of a hedge fund firm, right?
Yep.
You are investing in the market, though. I'm curious how you're investing in the market right now.
Well, and we're advising clients. Look, I mean, I just advised a client on a put basket strategy this afternoon, and right now, what we're seeing in the universe of companies we follow is probably it's as attractive a time as it was in first half of 2021. And I've said publicly that 2021 was the most speculative market I've ever seen in my 45 years of investing. And we're getting back to that. Not quite there, but it's close. And you've seen it with things like the meme stocks again. And my God, we're starting to price SPACs again. I noticed that there's $3 billion of SPACs priced.
Does that give you agita, particularly the run-up we saw in GameStop? And yeah, I mean, SPACs are somehow trying to claw their way out of the grave.
People have always said, well, what about the Fed, per your first question? And I always said, well, give Wall Street enough time. The Fed is not the only one with a printing press. Wall Street does a pretty good job at issuing pieces of paper when people really want them.
I mean, how do you sort of navigate? And you talk about advising folks. You're advising people on a public market, a public equity market, at least right now, that is at record highs, at least on the S&P and the NASDAQ.
Yep.
A lot of people would look at historical valuations and say, we're stretched here. What is the advice you give in that situation?
Well, since really the mid-90s, we ran our business where we were long equity markets, we were long indices, and then short our names. And I still think that makes a lot of sense. And where the stock market is going, I have no idea. Mm-hmm. I started my firm back in 1985. The Dow was 1,300. So I mean, that should tell you something about timing. But the fact of the matter is that with the exception of the far right group of companies on the bell curve, most companies underperform the stock market over time or fail. Mm-hmm. It's the NVIDIAs or the Teslas or whatever on that far right end that go up quite a lot that give you your returns. So the strategy of being long equity markets broadly and short idiosyncratic names, I still think makes a lot of sense. And then finally, insurance is really cheap right now. Mm-hmm. I mean, people insure their homes, they insure their cars, they insure their loved ones. It's pretty cheap right now to insure a portfolio.
Is AI in a bubble?
I have no idea.
You lived through bubbles? You lived through
I've gone through bubbles. I'll make one observation as it relates to AI. So if you go back and look at the U.S. economy in the immediate post-internet age, and I think we can all agree the internet changed our lives in a major way. From 1998 to 07, the U.S. economy grew at 3% real annually. From 1988 to 1997, the 10 years prior to really the advent of the internet to the public, the economy grew by 3% annually. The internet had no impact on growth. Now, it had a lot of impact on individual companies, getting back to my point, right? There were big winners and big losers.
Right.
And I suspect if AI is going to be as transformational as people think it is, and I have no idea whether it will be or not, there'll be big winners and there'll be big losers.
I just want to follow up on that, though, too. And this kind of leads back to this question Scarlett started off with about the connection between macroeconomic conditions and our markets today. And there does seem to be a disconnect.
Yeah, I wouldn't disagree with that. And I think there's a much more speculative nature of this market. And we started to see it in late 2019 when commission rates got cut to zero. And retail began to come back in the market in a big way, in ways they hadn't been in. Prior to that, they'd been investing in ETFs or mutual funds or what have you. And we began to see pre-pandemic speculation in individual names really pick up. And then, of course, post-pandemic, it took off. And we're still, you can see it in option volumes and a lot of other sort of quantitative measures that the public is in this stock market in a big way. And that really then means that you have to change your risk parameters, change the size of your short bets, if you will, and be mindful of the GameStops and those kinds of things. On the other hand, generally they chase momentum and sometimes, quite frankly, silly stories. And if you want to be investing, you don't want to be doing that.
If you were looking at the AI story, and I get you can't say it's a bubble, but it's spread out in lots of different parts, right? Utilities have been up, power has been up, you have hardware coming up, you got software, like it's like the tentacles are moving out.
Right.
How do you think about something like that? Like how do you?
Well, we look for, I mean, for one, we look for companies in our world that have gotten the benefit of an AI, kiss, but are actually going to lose because of AI. So we've been publicly short the data centers, the legacy data centers, because they literally are not designed for AI chips. They have to basically be retooled completely. And all of the infrastructure and hardware in a data center, an old one, is not compatible with the new chips. So people have bid the stocks up thinking they're AI plays. They're actually losers from AI. And it gets back to the winners and losers thing.
We mentioned SPAC companies a little bit earlier. I'm wondering if you're trading around the elections at all. What might a Donald Trump victory in November, for instance, mean for regulation? And would that, as a result, perhaps create more opportunities to be short companies? Because, with the regulatory heat taken off, companies can do all kinds of things, and speculative fever goes up.
Yeah, I mean, it's hard to bet based unless you know who's going to win.
Yeah.
It seems like I still think it's going to be a pretty close election. And obviously there's certain areas that each party would emphasize and de-emphasize. I mean, again, some areas that we're already negative on, like solar, would probably lose under Donald Trump. But it's hard to know exactly, particularly if the polls are right, that it's still a pretty tight election.
Yeah, and of course, he's a booster for all kinds of companies, including his own SPAC. You've been very vocal about how irrational retail day traders are. How much can a charismatic influencer like Roaring Kitty, aka Deep Effing Value, and what's his actual name, Keith Gill, and an army of day traders keep this GameStop dream alive? I mean, from where you sit and looking at it, at some point it comes crashing down, does it not?
Well, it already has. I mean, so if you look at the meme
But there's little blips here and there.
Yeah. But if you look at the meme stock class of 2021, which was GameStop, AMC, Bed Bath & Beyond, a number of others, I mean, with the exception of GameStop, they are all down 90, 95, 99%. It was a disaster for retail investors, quite frankly. And so I think that it gets to my point that you don't want to be chasing this stuff if there's no fundamentals behind it. And I have no position in GameStop, but people are still valuing that company, if we're going to value a business, at 3 times its cash. And even though it's raised all this cash, it's got about $9 a share in cash right now per share. I think the stock's at 25 or 26 or 27. And so you have to believe the business has something, or there's option value to the cash, which is what people believe, that Ryan Cohen will be able to do something. That's really hard to do when you're paying $3 for $1 of cash. And again, so you're chasing the future, you're chasing the story. In bull markets, the future gets a premium. In bear markets, reality gets a discount.
Well, when we talk about that premium, particularly when it comes to GameStop and some of those meme stocks, let's talk about potentially the other side of that trade, which is sort of the short positions. We saw that in 2021, where the short interest went through the roof. We're not seeing that necessarily as aggressively this time.
The opposite.
But part of that reason is because there aren't a lot of folks like you doing this anymore. A lot of those folks got scared off. Obviously, we know what happened to Gabe Plotkin, and a little bit earlier, we were just talking about Andrew Left, who had a short position in GameStop, but even he closed that out.
Yeah, well, again, we can just look at the numbers. Overall short interest is down, as you allude to, but take a look at GameStop again, just use this example. So a week or so ago, 10 days ago, short interest was 22% of the outstanding or of the float. Today it's 11%. A, the short interest went down. B, they issued a lot of shares. Getting back to my point about issuance. So the supply increased, and now the shares are. So now it's not a short story anymore. The shorts aren't trapped. In January of 2021, I think the short interest was 140% of outstanding.
Yeah.
And now it's 11. It's a big difference.
Okay, so that maybe that's not a target. Is there sort of a market, or more importantly, appetite for that sort of short seller's playbook, a playbook that you made famous? And it just doesn't seem like there are sort of new Chanoses coming around the corner in this space anymore. How do you feel about that?
I don't know. After 45 years, I don't wish that on anyone, maybe.
But there are people who want to aspire to that, right? Are there players in the market?
There's some really good. There's some really
good?
good people on the short side out there that are doing great work.
Like who?
Like the folks at Hindenburg, I'm a big fan of, and others. And we never did the short activist model, but the work they're doing is I think the fundamental work, which is what I look at when I look at people's work, is really first rate. And so it's out there. And I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are trying to take advantage of investors. So we need short sellers more than ever.
We need short sellers more than ever, but the government's cracking down on all of them, right? This ongoing investigation into activist short sellers has resulted in its first charge. I believe Anson Funds and Anson Advisors
I saw that today,
were accused of hiding payments to bearish researchers.
It was a disclosure issue, really.
It was a disclosure issue, but it's something, right?
Yeah, I think that was the issue, and we were never involved with that, and that was never part of our business model. But I think that the issue that the government was worried about in the SEC and possibly justice was disclosure. Were there people funding these things that was not disclosed that should have been? I could argue that legally, but I think that was really what the issue was were there third parties involved in funding this that should have been disclosed or not. Yeah,
it goes back to that idea that there's a lot of ways to make money. Short selling is complicated, it's expensive, and it's certainly a risky way because your downside is unlimited. You shut down your hedge funds last year, yet given where we are in this market cycle, you say we're in the golden age of fraud. This might be a good time for short strategies in terms of performance. Do you see it getting a little bit easier to raise capital from institutional investors for short strategies?
It's harder.
No?
Yeah, and that's part of why the opportunity set is there. Nobody wants to do it. And so I think that's what's so interesting. And of course, you had the growth in the platform companies, the so-called pod shops. So a lot of short selling is done through those vehicles in terms of dollar value. They've certainly supplanted the long-short world in a major way. But with tighter risk models, so we see more volatility sometimes because those platform companies keep short positions small, and if they move against you a certain amount, you're out. But by the way, that works on the long side too.
But do you think, though, that long-short strategy might actually have some value at some point in time?
Oh, absolutely.
Because, we talk about this idea. You can't have a market that's all long. That doesn't work forever, does it?
I don't think so.
Okay.
And as I said, we have 40 years of almost of numbers that kind of prove that wrong.
Yeah.
In pretty much straight up market. So I think that again, as long as you're doing your work and don't focus on the short term and understand that a dollar is not worth $3,
right?
And you shouldn't pay $3 for it. And if you can sell it for $4, that's maybe not a bad trade. I think there'll always be room.
I was having a conversation with a long-short manager, and she kind of pointed out this idea of, at least in her mind, that price transparency or price discovery was not as easy as it used to be. So that made the strategy a little bit harder. And she pinned some of that on the distortions coming out of the private markets. The idea that private markets have stolen a lot of thunder from public markets. You don't necessarily have the same balance or equilibrium in private markets, in public markets, that you had in the past.
That's an interesting theory.
Yeah.
I have not considered that the private markets would impact the short side in that way. I think the private markets, the growth in private markets has had a lot more to do with capital raising, particularly in the public market arena, including long short. I sit on a couple of investment committees, and we've been doing nothing but redeeming hedge funds and giving it to private equity, private credit. And in my own view, I think that's not the right thing to be doing right now. I think that wherever you see a flood of money for years and years and years, it's been pretty much, you're not going to get the outsized returns that you had 10 or 20 years ago.
Jim, let's circle back to individual stocks. Why don't you like solar stocks?
I don't like solar stock. I don't like the residential solar stocks because the business model doesn't work, no matter what rates do. The concept of putting up panels on someone's roof and then leasing it from that company, if you just look at the numbers of the companies that are in that business, like Sunrun or Sunnova or whatever, they bleed cash. And they use accounting constructs to tell you why it's really economic. And meanwhile, they're just burning hundreds of millions of dollars per quarter and have been for years and years and years. And I think that is just simply an accounting story.
What else don't you like? You laugh. It's interesting to get your take because solar stocks have been on a tear.
Yes, well, the last couple of weeks.
Yeah,
they were actually hitting new lows just last month. And so they bounced because of the view on rates. We're not going to talk about the Tesla shareholder vote?
Well,
Well, let's hear it.
I was setting you up. You're taking away my thunder. I asked you that.
I was waiting for someone to come up behind me. We don't like the data centers and haven't. We've been public on that for a long time. I'm puzzled by the number of restaurants that are trading at absolutely insane valuations in an industry that, ultimately is not a secular growth business. You can find stocks at 50 times cash flow and 100 times earnings. And there's lots of companies that are kind of mundane that have been bought by growth managers where the returns on capital are low that are trading at 50, 60, 70, 80 times earnings. You can find them. There are a lot of them. And so it's a pretty target-rich environment right now if you're doing fundamental work.
Okay, now
I'm sorry, did he answer the question on Tesla? No,
the
question he asked himself.
Yeah. Well, Tesla is holding its annual general meeting tomorrow, and you were famously short Tesla at a time when it basically defied gravity. We know that shareholders are going to be voting on Elon Musk's $56 billion pay package, not from this year, not from last year, but from a couple of years ago. Yep. What is that emblematic of? What does that tell you?
Well, first of all, it might shock some of your viewers, but I tweeted out a week ago, I actually think that people should vote for the package.
Really?
I think, even though I'm a bear on Tesla, I think a deal is a deal, even if it's a bad deal. And they agreed to it. Now, the judge even if they voted in again, doesn't mean it may happen. It may not obviate the ruling. But I do think a deal is a deal, and that if you voted for it, that he should get it. Having said that, the value of the package is in excess of all the retained earnings of the company's ever made, even post-package. And the one thing I pointed out today, the one thing I've been scratching my head on and going back and looking at this package from 2018 was that the deal was contingent on hitting certain numbers and the stock price hitting certain values. But what they didn't do was make each tranche the new equity award that he got for doing that, the strike price of that option at the stock price at that moment. All of the equity for all of the tranches was set at the original price, which was $23, adjusted for the split. So that means there's really no clawback provision, and basically it means if the stock goes up a lot and then goes down a lot, he still wins. The shareholders don't necessarily win. And in fact, I think the stock price is below where he earned the last tranche already. So it's a little bit like a hedge fund manager saying, okay, well, I was up 40% at mid-year and then gave it all back in the second half of the year, but you should compensate me on the fact that, I was up a lot at one point.
Yeah.
And so that's the one aspect of the package I think shareholders should really, be kind of kicking themselves on. I think that the tranches should have been set at each point at which the stock price had to go to. But having said that, I think he should get it. I'm not a big fan of Elon. There's no surprise of that. But a deal is a deal. It is, however, a very expensive deal for the shareholders. And what does it mean about going forward? What's going to be the next demand?
Do you think it would be better, though, if they structure, I know they can't really restructure, or they can, but if they tried to restructure it, would it be better to sort of make some of those metrics tied to the performance of the company itself, not necessarily the stock, but I'm talking about sales?
Yeah, it was both. Yeah. So the award was tied to both, and there was various formulas. Look, anytime you tie it highly to stock, it's problematic because you run the risk of someone being overly promotional to get paid and then worrying about it later. And I've often said that lavish stock option programs are undervalued in the marketplace in terms of their expense, because if you have a board that's very acquiescent, and that's Tesla, and you don't get fired for aggressive, risky behavior, if you engage in risky behavior to get lots of stock option payouts and it doesn't work, it actually becomes in your self-interest to have the stock price go down so you can reload at lower prices. So in effect, when you've issued call options to an executive, in that case, you've also issued them put options. And a lot of people don't realize that. And so I think that it makes share-based compensation problematic for that reason, and also for the reason that everybody simply adds it back for adjusted earnings, which is another accounting game being played.